Okay, so welcome back everyone. We're going to continue with question number 3, which specifically focuses on your financial statements. Now, in this question, if we just scroll to the required, let's quickly see what they're going to ask you. So, just remember for this learning unit, there's multiple ways of which they can ask you this question. So the first way, which in this question they've done, is they ask you the journals. Now the problem with journals is students perform really badly in journals because of the fact that they can't do the basic disclosures. So my suggestion is when you study this, the journals will be exactly the same. It will only be what account is being accrued for or has been received in advance. So I would suggest go draw up sort of a basic set of basic types of journals you can get and go study those. All that will happen in a question is you would use the same type of journal. The only thing that would change is the amount and potentially what type of asset or expense it relates to. But if you accrue, for example, expense, the accrued expense would remain exactly the same. It would just be what expense is being accrued, for example. But when I get to that in the question, I'll just show you again what type of journals would be the same and what would, for example, change. The second thing is they can ask you disclosure. Now they can either ask you a set of financial statements, so either the statement of financial position, statement of profit and loss, or statement of equity, or the note disclosure. They will not ask you all of them, they will ask you components of them. So in this question, they ask you for an extract specifically for the current liabilities, if I remember correctly. Oh no, that was the other question I loaded up on VC for you. So the main things they could potentially do is an extract of a statement of financial position. So only ask, for example, for assets, or only ask liabilities, only ask equity, or they can ask you note disclosure. Now, if they ask you a statement, for example, of profit or loss, statement of financial position, statement of equity, you only have to do the element that they ask you for. You don't have to do the full disclosure. If they want you to do note disclosure with it, they need to specifically indicate that you have to do the notes. They could also just ask you for the notes. So they can ask you, okay, trade and other payables, what is it made up of? And then you have to do the note disclosure. So you should know trade and other payables, for example, is made up of your creditors control, it's accrued expenses, it is income received in advance, and then any short-term portions of a loan would also be included in that component. So you need to know what makes up that specific category. So the examples in your textbooks where we did the note disclosures as well, go through them when you study to make sure that you understand what is captured under what specific note. Okay, now let's quickly see what was asked for in this specific question. If I scroll to the required to, we were asked to journalize the adjustments, and then they give you the first journal number. So that means you need to include that journal voucher number in your disclosure. So they want us to do the adjustments. So the adjustments in this question is all your additional information. Then they tell you, note that subsidiary journals have been closed off. So all additional transactions will be recorded in the general journal. Now, the reason they tell you this is normally if they don't tell you it's been closed off, you would have to go capture it in that specific journal, whether it is your creditors journal, your creditors allowance journal, debtors allowance journal. You would be required to go record it in a specific journal. Now, if we tell you they've already been closed off, that means any adjustments that we need to make will only be captured in your general journal. And they tell you no narrations, journal narrations or folio numbers are required. Okay, so that means when we do the disclosure, I do not have to capture a description of what the journal is for. I have included it for information purposes, and you do not have to disclose whether it is a financial statement position number or a nominal account, so the B or the N numbers in your folio numbers. You do not have to specifically show that. And they also tell you you are not required to journalize closing transfers. So that means any nominal accounts, I do not have to close them off to either your trading accounts or your profit and loss account. It's not required. They only want you to document the adjustments. Okay, so in this question, they specifically told you what is excluded. So when we talk about journalized adjustments, we have to go through the additional information provided in here, and we will have to document that as a journal. So we're going to read through the information, and then we'll look at how do you actually document each journal. Okay, so the first one, they've asked you to provide for depreciation. Now, what I've said is if you're not sure if depreciation has already been recorded, you normally just scroll up to your trial balance and you go look at your nominal accounts, which starts there, and you have a look whether any depreciation charge is shown there. Now, you will see there's no depreciation charge, so that means I still need to account for it. Now let's see how depreciation is calculated. The first one is your motor vehicles is 15% per annum on the reducing balance method. Now we said reducing balance method is on your carrying amount, which is my cost less my accumulated depreciation in the beginning of the year. Okay, they do not indicate any additional information of purchases during the year, so you would only take the information as is in the trial balance. If we look at the equipment, we've got 10% on cost. And then they tell you a new piece of equipment was purchased on 1 September for 54,000 and has been recorded. So that means our opening balance will be calculated as follows. So we take, in our trial balance, we see equipment is currently 156,760. Okay, now because we've already recorded the purchase amount, so it has already been recorded, it has been included in this balance. So we need to remove the new equipment from that amount to work out what is the actual cost of the inventory before we added the new inventory to it. Because this amount would be depreciated for a full 12 months, whereas your 54,000 would only be depreciated. Okay, so let's quickly see when our year end is. Our year end is end of March. So that means we've got September, October, November, December, January, February, March. So it's 7 months that it would be depreciated, your new equipment. So that's why we have to go split the equipment amounts for the calculation specifically.
Sorry, ma'am, where did you get March?
Yeah, from the table at the top. Yeah, ended 31st of March.
Okay. I was just confused because it said must trade instead of June.
Oh, that's the previous question.
Oh, I'm so lost. I'm sorry.
Okay, so our year end is 31st of March. The 30 June is the previous question. So just in the test, make sure that you read the correct question information. Okay, it does happen that you must look at the information, so that's also why I want you to show calculations. Then at least we can give you some marks. Okay, what you can also see is the accumulated depreciation is on the 1st of April, so it means it is the opening balances. The depreciation has not been accounted for as yet. Okay, let's quickly see what other information they have before we do all the calculations. 4.2, they tell you that the owner took trading inventory for personal use. Okay, so once you take it for personal use, it is drawings. What is important to note is you need to look at what type of inventory system do they use. And why do I say this? Because the one goes to assets and the other one goes to expenses. Okay, so they need to specify the type of inventory system. So let's read what other information they give you. They tell you the selling price is 4,800. VAT is not applicable, so we do not have to worry about that. The markup is 50% on cost price. Now remember, when you take something for personal use, I take it at the cost. Now how do I work out the cost? We say cost is always 100 if the markup is in cost price. So the markup is 50. So that means the selling price would represent 150. So to work out the cost price, you take the 4,800, you multiply it with 100, which is the cost that I want, divided by the 150, which is the sales amount that it represents, and then you get a value of what? If you do that calculation, 4,800 multiplied with 100 over 150, what do you get? Okay, so then you get 3,200. So that is the cost of that inventory. Now they tell you the transaction has not been processed, so it has not been recorded as yet. We still need to account for it. And then we have a periodic inventory method. So when we have periodic, it is expensed. So it goes to our purchases account. So that's why you need to know what inventory system you are looking at. Then the next thing they tell us, telephone fax invoice for March 2020 of 2,430 Rand and 15 cents has not yet been paid. So if it's not been paid as yet, it has not been captured in our journals, so we need to go accrue for this expense. So it's an expense that relates to our financial period, but we haven't accounted for it, so we accrue the expense. Okay? Then number 4, they tell you that our debtor, C. Bing, owed an amount of 6,500, was declared insolvent. 35 cents was received, so they paid 35 cents into a rand, and the rest has been written off as irrecoverable. So that means when you do the calculation, 35% will go to your bank because that's received, and then 65% will be credit losses. So that's what, if we write it off as bad debts. Now, if you're not sure if you take it to credit losses or bad debts, just scroll back to your trial balance, and there you would see what the account name is. So you use the account name as indicated in your trial balance. So in your trial balance, they've indicated it as credit losses and not bad debts. So there you know you need to use the credit losses account name. And you use the names that they give you in the trial balance when you do the journals. Then if we go to point 5, the allowance for credit losses must be adjusted to 1,600. Now, if you go back to your trial balance and we look for your allowance for credit losses, this is on the 1st of April. It is currently sitting at 1,780 Rand and 25 cents, and it should be 1,600. So that means we need to reduce it by 180 Rand and 25 cents. Okay, so that is what that information in that point indicates to. Then insurance expenses for April has been prepaid. Now what that means is I've already paid that amount for April. They tell you the premiums remained the same. So that means I have actually paid, so my expense, my insurance expense is for 13 months. And that is how you are going to work out what is the amount you need to remove. That's why they tell you that the amount has remained the same, so that you know it is exactly the same amount. You can just divide it with the number of months it represents. Then rent income. For April 2020, for 4,200 has been received in advance. So we said when we receive income in advance, it is income received in advance. And this is a liability, because if something happens to the business at that date, I would have to repay that amount to the tenant because they haven't actually used the property for April. Okay, whereas an accrued expense would be what? Okay, so it's also a liability. It's going to make like this. Up it here. Okay, then if we look at number 8, we say service income of 5,430 has not been received for March 2020. So that means it's income. I've already delivered the service. The income is supposed to have been received. So similar to accrued expense, we have accrued income. And this is an asset for us because this is money that is coming into our bank account when it's eventually paid. Then number 9 is your stock take revealed, what the actual balances are. So these are the balances at year end, and we need to adjust our balances to reflect the new values. Okay, so now let's go look at how do you actually record each and every transaction. Okay, so let me just, I'm going to share the Excel file with the guys online. Just let me know if you can see it.
And is this session being recorded?
Yes. Okay, guys, can you see the Excel online? Okay, so let's start with transaction number 1. So we said for depreciation, you need to look at what method you are using, what percentage, and if there were any additions. So if we start with motor vehicles. Motor vehicles is 15% per annum using your reducing balance method. So what we need to do is we have to go work out the carrying amount. So I'm going to do the calculations on Excel and just explain what it is on the piece of paper that I have next to me. Okay, so for the first one, for motor vehicles, our accumulated depreciation was 22,580 and our vehicles cost was 220,987. Okay, there weren't any additions for vehicles, and it is 15% on the reducing balance method. So what we will do to do the calculation is we will take the cost less the accumulated depreciation to work out the carrying amount. Now, when we do this entry, depreciation is our expense, it will be debited, okay? And accumulated depreciation will be credited. Now the calculation would be the cost less the accumulated depreciation, which you find on your trial balance, multiplied with the 15% to give you a value of 29,761 Rand and 5 cents. Now, you did not have to give narrations, but I'm just going to include it here at the bottom so that you know what it's supposed to be. And you do not have to document the folio numbers. If you had to document folio numbers, you would, for example, had to show the 7-year for the accumulated depreciation, and then you would have created a depreciation account, for example, under N22. Okay, so that is what folio numbers mean, but it wasn't required for this question, so you did not have to disclose it. So that is the depreciation for your vehicles. Then they said for equipment, it is based on cost, so it's 10% of cost, but remember we purchased an item for 54,000 during the year. So that needs to be accounted for separately. So the journal looks exactly the same as the previous one, except accumulated depreciation is for equipment. Our calculation is the 156,760, which is in your trial balance. We remove the 54, which is the addition during the year. We multiply that with 10%. And then we add on the 54,000, which is the new vehicle, and then we only work out the depreciation for the 7 months that it was used for. And that value, when you do the calculation, is 13,426 Rand. Okay, are you all fine so far? The guys online, are you okay with the depreciation so far? Okay, then if we go to number 2, we said we took inventory for own use. We said when an owner takes inventory for their own personal use, it goes to drawings. Now, drawings is an equity account that reduces your capital, so we debit drawings, okay, but with the cost amount. So we worked out the cost was 3,200. And because we're using a periodic inventory system, we take it to the purchases account as opposed to the inventory account. So that was what you had to see from that information. Okay, so that is the inventory that we've taken. Okay, so I'm just going to highlight this so that you guys just note you need to look out for the specific inventory system. Then point number 3, we said we received the telephone and fax invoice, but we haven't yet captured it. So that means we are liable for that expense. But because we haven't captured it as a creditor as yet, we take it to accrued expenses. So you debit your expense to increase the expense amount to reflect what the expenses for the year should be. And you credit the accrued expense. I'm just going to put here in brackets. It is a liability account. Please don't put liability when you do the journal. It's just that you know where it's supposed to go. And then you would enter the amount of 2,430 Rand and 15 cents. Okay, then transaction number 4. This is where we received a portion of the debt and a portion needs to be written off. So the first transaction you record is the amount that was physically received. So we said 35 cents of the 6,500 has been received. So when we receive money from a debtor, it goes to the bank account. We debit bank and we reduce debtor's control with the amount received. So the first transaction would be the 6,500. You multiply it with 35 over 100 to get to an amount of 2,275 Rand. Now, the next transaction, you could have consolidated it with the previous one, but you don't have to if you prefer doing it separately. So then you debit the credit losses. So that is the amount I'm writing off as irrecoverable. That is the difference between the amount that is outstanding, the 6,500, less what I physically received in the bank. And then I reduce the debtor's control with that same amount. Now remember, that means that debtor's balance should be 0 after these 2 transactions. Now, if I say you could have done it as one, it would have looked as follows. So I'm just going to show you if you do it as one entry. Then you would have done bank for this amount. Okay, so if you combine it as one entry, you would do bank, you would do your credit loss for 4,225, and then you would credit your debtors control with the full 6,500. So that is if you want to combine it as one entry, it would look as follows. So I'm just going to put it as this. If you want to do one entry, but above 2. Okay, so that is how you would have done one entry as opposed to 2. But to make it easier, maybe do 2 if you're unsure how to consolidate it into one. Okay. Okay, then the next entry you had was number 5, which was the credit allowance or allowance for credit losses. Now, in class last time I said when they ask you to adjust the allowance for credit losses account, you create an allowance for credit losses adjustment account just for that adjustment amount, and then you record it as follows. Okay, so you would debit the allowance for credit losses, which is the current account in your trial balance, and we said we need to reduce it. It is a credit balance of 1,780 and 25 cents, but we want it to be 1,600. So we reduce it, the credit balance, by debiting it with the difference, which is the 180 Rand and 25 cents. And then that movement we take to our profit and loss statement, but now we have to create an account for it. So you take allowance for credit losses, the account name, and you literally just add adjustment to the end of it to get the new account name. And that is how you bring in that entry. Then number 6 is the insurance expense we've prepaid. So we want to take the expense out of this year's profit and loss and move it to the following year's profit and loss. So what that means is we need to reduce our insurance expense. Now insurance expenses are normally debited, so reduce the expense, we have to credit it, and then we have to debit prepaid expenses. Okay, so prepaid expenses is an asset account. That means if we do not get that use of that expense in the following month, the person needs to pay it back. Because of the fact that they said there was no change for the last 2 years, you just take the amount in the trial balance and we know it's for one additional month. So it's 13 months and that's how you work out the monthly amount. Okay, so that's entry number 6. Number 7 is the rent income, which we received in advance. So it means our rent income amount in our TB is more than it should be. So we reduce it. Normally we credit rent income, but now we have to debit it to reduce it. And then we credit the income received in advance, which is a liability account. Okay, so that's that entry. Then entry number 8 is the service income. So we've already delivered a service, but we haven't received the money. So I need to show it as income in my trial balance. So I am going to credit service income But because I haven't physically received it, instead of raising debtors control, I create accrued income, which is also an asset account for 5,430. Now, the journals that I was talking about, that would remain the same as these ones. Just going to highlight them in a different color for you, in green. Okay, so the things that would generally change in a question would be these account names. So they will ask you exactly the same entry, they can just ask it for a different type of income or a different type of expense. The allowance for credit losses can either be this way around or just the opposite way around, depending on what you need. And then these ones, they always ask these ones as well. And from this, the only thing that would generally change is the type of expense account. For your debtors control, it would only be who the debtor is, so the name of the debtor would change, and then potentially the percentage that you receive. But the journal would look exactly the same. Okay, then if we get to number 8, this is now where our stock take, they also love to include this. So the stock take, you need to look at 2 components. The first one is your consumables on hand. So that is any stationery, any consumables, any cleaning materials. Would generally have been shown as an expense. But for those items at year end, if we still have stock on hand, we create an asset for it and we remove it out of the expense so that in the following year, we show the expense in the correct year. Whereas with trading inventory, you change the trading inventory balance that is shown in your trial balance as an asset to the correct balance. But because we are busy with a periodic inventory system, the movement from the opening trading inventory balance to the closing inventory balance would then go to purchases. And we would normally do this as part of our closing transfers when we work out the cost of sales. But because they didn't ask you for the closing transfers, you have to do the movement to the purchases account. So if we look at the first entry, the consumable stores on hand, you take the cleaning materials amount that they've given to you, which is the 1,432 Rand. You go credit it. So you reduce the expense with that amount. The same with the stationery. You reduce it with the 568 Rand. And then you sum that together and you create an asset account. So this is basically asset. I'm just going to say it's inventory, just so you know what it is. So we create consumable stores on hand, and we then take that and say, okay, we have the stock on hand at year end. So we haven't actually used it up, so we can't expense it as yet. This journal entry, they will ask it as well. If they ask journals, they always ask it. So make sure you know it. Okay, and then the last entry is the trading inventory. So we said because we're busy with periodic inventory system, we will take the trading inventory to purchases. Now, if you look at your trial balance, the first table, the trading inventory balance in the beginning of the year was 27,865. If you look at point 9, they tell us the trading inventory now is 15,640. So we have to reduce the balance to 15,640. But what else still needs to be taken into consideration is that balance that they've shown in our trial balance have not taken into account the inventory that was taken by our owner. So all of those transactions and the stock take all occurred at the same time. So what you have to do is you also have to deduct that 3,200 when you work out the movement. Otherwise, you are going to account for it twice. Okay, so you need to take it out of the movement because that also affects the purchase account. And then we take it to purchases. Okay, and that is how you do the journals. This one they might ask, but this is not the most common one, but this is how you account for it if it is the periodic inventory system. Okay, so do you guys have any questions on the journal entries? Make sure you know them. I don't want you guys to lose. In this question paper, it was 30 marks. I don't want you to lose 30 marks because you can't do basic journals. Okay, so any questions? Any questions online? Okay, so the guys online, do you have any questions for me?